Welcome to Part 10 of Auditing Standards number 5. AS5 has over 100 pages, so I'm going to make it easy to understand by talking through keywords, key concepts, and in this section, we talk about 3 particular ones. Special considerations for subsequent year's audits, evaluating identified deficiencies, and indicators of material weakness. This training gives context to SOX 404 requirements. It's meant to be an easy breakdown of dense words. So the table of contents here came directly out of Auditing Standards number 5 from the PCAOB website. I just grouped the sections into smaller chunks and made video instruction blogs out of them so that it's easy to digest. So I want you to look at the table of contents and find the sections that are of interest or focus to you and watch those videos or read those blog sections to get an idea of what these sections mean without having to read the original literature itself. But along the video, you'll see the original literature so you can refer to it. Special considerations for subsequent year's audit. Yet another long phrase to mean things to consider for the following years. Remember again that Auditing Standard number 5 is for external auditors, and as SOX auditors, we've essentially adopted it because it's like saying, here's the test that's going to be given. So as students or people who want to excel or pass the test, we want to study what's the material in the test. And you'll see here in paragraph 57, it's pretty intuitive. Again, it says, incorporate what you learned in the past audits to determine what you're going to do this year or the next year. And the factors that they list in paragraph 58 is actually very similar to what you've seen before. Nature and timing of the extent in previous audits, what were the test results, whether there have been changes in the process since last year, and you take into account the risk factors, right? So you still have to do your risk assessment, and then you look at the results from last year. Now, paragraph 60 talks about benchmarking strategy for automated application controls. And this one, let me expand a little on that. Benchmarking strategy is, think of when a company first puts in a new ERP system or first upgrades to the latest version. So if a company first implements NetSuite, if that first year, as external auditors or as internal auditors, we are able to test and say, this is the baseline. Here's the standard configuration that was originally put in, and we're very comfortable. We tested all the standard configurations. That becomes the baseline or the benchmark. Every year after that, we don't have to go and test every single control and every single configuration again. We just have to look at a log of system activity to see, have there been any changes? If there have been no changes between the last time we tested it and this year, there's no need to do anything. We just have to scan through and say, look, I got out a system-generated log, and it's important when we do this testing to make sure it's truly system-generated and it's not something the client lists for you. Oh, here are all the changes. Well, what if they exclude this manually generated report, things that really big that happened? So it's the same if you have an Oracle. A lot of our clients use Oracle. So if they do an upgrade, and many clients now are going to R12, right, 11i to an R12 upgrade. Well, during that initial implementation, we may be testing application controls, we may be testing functionalities and segregation of duties and setup of various roles. Once you do that initial testing, that becomes your baseline. And after that, we only have to test the changes to see how it impacts the controls. So it's a lot less testing if you can do a solid benchmarking. And that's what this strategy is. And then paragraph 61 just says, by the way, you should vary what you're doing year after year to add an element of unpredictability. Sometimes you'll hear auditors say the phrase SALY, S-A-L-Y, same as last year. Well, if you keep doing the same thing over and over, the client kind of anticipates that, or the company and people anticipate it, and maybe they purposely do certain things because they think, oh, they're not going to look at this area. I'll just hide whatever I want to hide in this area. So you want to change things up periodically based on the circumstances. And every year, companies change, grow, expand, contract. And so it's very hard to always say it's exactly the same as last year. Maybe some of the procedures, the types of testing we would do changes, but the timing or the extent of it will vary. That's all this says. That's it for considering subsequent year's audits. Evaluating identified deficiencies. So we've done all of this work leading up to this, planning the audit, assessing the risk of fraud. We looked at materiality. We selected the controls that are key to us, and we've done some testing, and we're going to now have a bunch of deficiencies. We always have deficiencies. Every company has deficiencies. Now it's whether the deficiency is a deficiency, a significant deficiency, or a material weakness. And that's what this section talks about, is how do we evaluate some of these deficiencies. Paragraph 62 talks about when you evaluate the deficiencies, you have to look at individually the deficiency and in combination, all the deficiencies together, could it equate or equal a material weakness as of the company's year end, which is also the date of management's assessment. And paragraph 63 says, the severity of deficiency depends on reasonable possibility that the control would fail or fail to prevent or detect this mistake, and the magnitude, meaning the amount. So how reasonably possible would it be to happen, and how big is the mistake? Paragraph 64 talks about the severity of the deficiency isn't whether the deficiency actually occurred, but what's possible in terms of what could have occurred. So let me give you an example. We might have found a mistake for $100, but could that mistake been for $200? Could it have been for $500? Could it have been for $100,000 or $1 million? At which point would the company's controls detect or prevent that? And whatever the maximum is, that's what we're looking at, is the potential misstatement, not the actual error or $100 mistake that we found. Paragraph 65 talks about, here are the factors that we would consider to add to our determining what type of deficiency it is. So we have to look at the nature of the financial statement account or the disclosures. So if it is in the account, if it's a small mistake in the disclosures, maybe we transposed something because there are lots of numbers in a footnote disclosure table of some sort, versus was it on the face of the financial statements, instead of $5 million in cash, you put $15 million. That's something someone would easily have caught. But maybe in the footnote disclosures, you're transposing it, typos, those things potentially happen, but it's not so blatant. The next factor to consider is susceptibility to loss or fraud. Again, you're more likely to have loss or fraud in, let's say, a cash account, in a revenue account, accounts where cash is because cash can walk off. Cash is something people look at because that's your lifeline to your business, versus if you had a long-term other assets. Maybe it's not as critical or as susceptible to fraud when you've got other long-term assets. You then also have to look at the severity, complexity, and the judgment of the amount in that mistake. So if we found a mistake in cash, where it's a bank reconciliation, you look at a bank statement and the amount is black or white because it's the ending cash balance plus your deposits in transit minus your checks outstanding, that's easy to come to. But there may be some amounts where there's a lot of judgment, your AR reserve, for example. AR reserve because at a certain point someone has to make a judgment. Do you reserve 100% of an amount? Do you reserve 10% of an amount? That factors into it. And then you have to look at the interaction or the relationship of that control to other redundant controls. So if the deficiency we found is a control that failed, maybe there are two other controls that act the same way or would have caught the mistake for this control. Well, then if we tested those controls and those were working, we could say that our deficiency, the mistake we found, it's still a deficiency, but it doesn't really rise further than that. You also then have to consider the interaction of the deficiencies. An example is if a company has 10 deficiencies and 8 or 7 of those deficiencies are all around cash, investments and short-term types of investments and more liquid types of financial statement nature, well then maybe all of the 7 or 8 combined make it a material weakness because that seems to indicate multiple things failing in that area. Versus another company that has 10 deficiencies, but each of those deficiencies fall in different parts of the balance sheet, parts of the P&L. It's just because normal operations, you're going to find little failures here or there, but those are scattered. That's something you have to think about. And then also the possible future consequences of the deficiency. Now, this particular note here talks about when you have multiple deficiency failures that affect the same financial statement, account, or disclosure, that means it could add up to material weakness. I just discussed this using the example of 8 deficiencies that fail around one particular cash account. Paragraph 66 talks about when we look at the magnitude, when we look at the amount of the mistake, there are a couple of things. You look at not only the amount, but the total transactions that are exposed. An example is if we do a testing and we find a testing of 45 revenue transactions, and we find one of those errors is for $100. And because during that time, the system was not set up to review any of the revenue transactions, or the person who was supposed to do it, that position wasn't filled, and so all revenue transactions automatically went into the system without review. Now, the mistake is $100, but our total exposure are all the transactions from January to March when that control was not in place, or that someone was not doing that particular control. And so you actually have to go out and find all those transactions that meet that criteria that we found similar to the mistake, add those up. That's the potential magnitude of our mistake, not the $100 itself. And then it also talks about the volume of activity. So again, in our example where we found a $100 mistake, if that's in a balance, in an account that has millions and millions of transactions, well, there's more likelihood of being other errors. If we found $100, maybe there are other transactions similar to it. So that's higher risk, higher dollars. Versus if we looked at an account and we tested it and there were only 10 transactions total. Well, just that volume of activity, those 10, you could quickly look at it and say, oh, I can identify if there's a risk to that or not. Paragraph 67 talks about the maximum amount that's exposed. So similar to 66 when I talked about the maximum amount, not just the error that you found, but what could also be out there. Paragraph 68 talks about compensating controls. So in our example where during January through March, no one was looking at revenue transactions and reviewing and approving them, well, maybe the person wasn't reviewing each of those transactions, but you might have a second control somewhere where before invoices are sent out or before revenue is recognized in the system, an accountant looks at each of the invoice, looks at the revenue contract, checks all of these things before revenue recognition happens. Well, now we can say there's a compensating control that would have caught this mistake at that same level or slightly higher, but it's factoring compensating controls. So those are the factors that we have to consider when we're evaluating deficiencies. And in the next section, we'll talk about at which point does it aggregate, how does it aggregate up, combine up to become a material weakness. Indicators of material weakness. So this section, 69, is almost the continuation of the previous one on evaluating identified deficiencies. And 69 talks about what are the indicators of a material weakness. And the reason why material weakness gets so much focused is because unless it's a material weakness, it is not disclosed in the auditor's opinion. And in later sections, I'll explain what the auditor is required or not required. But the big thing for many clients and many companies is it's fine if I have significant deficiencies and deficiencies, but material weaknesses are something that has to be discussed and disclosed, and so they don't want that on their financials. And so here are the factors or indicators of material weakness. If there is fraud, whether or not material on the part of senior management. So it's also critical to focus on senior management. So fraud, if the CFO was stealing $10,000 or $100, even though $100 is not material, the fact that your CFO is stealing from you, that's an indicator more of your environment, your control environment. And that's why you've seen certain scandals, certain big things where they focus on senior management. So fraud doesn't have a materiality filter, particularly for senior management. Whether the deficiency resulted in a restatement of prior year financials. And the reason why the restatement is maybe the error that we found this year is a very small amount, but in the past, in the previous quarters or previous years, it was a bigger deal. If we have to go back and restate prior years, that creates more of an indicator for material weakness. And the external auditor has to consider, would the company's controls have caught this? If it would not have been caught by the company's controls, any of the controls, preventive, detective, system, manual, any of those controls, if it would not have been caught at that magnitude, then it would indicate a material weakness. And the other factor is if it's ineffective oversight by oversight of the financial reporting process by the audit committee. And again, the reason why the audit committee is being pulled into here is it's saying that's at the very, very top of your organization. If you don't have an effective audit committee overlooking your financial reporting and oversight of that, it could be an indicator of bigger issues that we haven't discovered, or it's just the an indicator that there's something wrong on a larger scale than just what we found. And then paragraph 70 is a lot of words, and you'll see this phrase, this term introduced, prudent officials. It basically says when you are evaluating the deficiency or combination of deficiencies, you have to put yourself in the position of a prudent official. And this is where creative writing comes into play, because oftentimes when we are helping clients argue or position themselves to say this is a significant deficiency rather than a material weakness, we bring out the prudent official that says, hey, as an investor, as a knowledgeable investor looking at the financial statements, if they found this particular, or if they spotted this particular error or this error had happened, would they have cared? And that's why sometimes operating in a particular industry or particular business is very helpful, or knowledge of that industry is helpful. Because if the error mistake was around revenue, for example, and you're a software company, well, there's a lot more scrutiny around that versus if you are in a biotech company and there is no revenue, and the prudent official is really looking at your research and development, your potential for the future, not really your existing revenue. So this is the term that people have used, lots of words around it. It just basically says you have to look at a combination of factors to see if it's a material weakness. And there's actually a framework that we use to evaluate the deficiency, and it goes through, first is, it has various boxes and so forth. And one of the future segments, I will actually walk through how to evaluate a deficiency using the framework of, is it material, is it reasonably possible, and the magnitude, and what compensating controls there are, but we'll walk through that in detail. Paragraph 70 is just lots of words to say, consider all these factors from a prudent official's perspective. And that's it on material weaknesses.